take you 6 months or a year to get that next round of funding, and you started a month and a half before you run out of cash or something like that. So really planning for your goals, where you want to go, understanding as you grow, things are going to probably get more expensive. You're going to have more payroll, maybe more marketing expense, and you need to plan for that in the future. Creating your budgets and your forecasts is part of that. Preparing cap tables as you're going out to investors. All they're going to care about is what percentage are they going to get? What's in it for them when they give you money? And you need to prepare that. You need financial statements. And if you get nothing else out of what I say today, I want you guys to understand how important internal controls are. I've worked on a lot of fraud audits and unraveled a lot of fraud for my clients. And it all comes back to they did not have controls. And the most important one, segregation of duties. Don't just give all your money to your accountant and just say, okay, great, you pay all my bills, you tell me what's left over. That puts them in a position, if they wanted to, they could be siphoning off cash and you might never know. This is your business. You own it. Know where your money is. If they do your bank reconciliations, make sure you are the one signing the checks or hitting the send button on your EFTs when money goes out so that you know where everything is going. And eventually maybe you have an accounting department and that gets spread out among them. Like I say, if you get nothing else out of this, don't just blindly turn your money over to somebody and never look at it again. So when you're starting to consider hiring an accountant, you're going to have to consider, do you want to do it in-house or do you want to outsource it to some firm that does that? And there's a lot to consider there. Obviously, I have a little bit of a bias towards outsourcing it because you can get higher level skills for just a few hours a week that maybe you need it when it's new and they handle all the training, all the HR, all the turnover, all the overhead versus you having to control that. But as you grow, maybe it is time to bring it in-house and maybe you're not an accounting expert, but there's still questions you can ask potential applicants to feel out how they are going to do. Do they really have the skills that you need? Have they worked in your industry? Have they worked with companies the size of your company? How would they handle a particular situation? What have they done in their day-to-day? How would they handle situations that are going to come up that are unique to your company? If they can't answer these questions, not a great sign. Ask culture fit questions. If somebody doesn't buy into your mission and love what you're doing, again, that's not a great sign. If you don't know how these resumes look, ask another CPA that you know to look at those resumes and help you filter out what's going to be a good fit, maybe what's not, maybe somebody that's stretching the truth a little bit. Somebody that's an expert in this can help you figure that out. There's dozens of accounting quizzes that you can give people online that are self-graded, so you don't have to know the answers, that can help assess their skill level. And then it's an obvious one, but checking references and asking the references, are they going to know how to handle this situation? So there's two types of accounting. There's the cash basis, and most companies start out this way. They're just doing their books, and it kind of matches the bank statement. So when you get money in the bank, that's when you record it. When a check clears or an EFT goes out, that's when you record the expense. As you grow, you're going to have to at some point switch to an accrual basis. And this is really when you start getting an accountant involved, because they're going to know the nuances of this. And this just basically says you record your revenue when you earn it. Doesn't mean your client has paid you yet necessarily. And your expense when it's incurred. Again, it doesn't mean you've paid that expense yet. And then you run your financials offset through the balance sheet. So you might have an accounts receivable or an accounts payable or other type of an accrued expense. You guys said you're familiar with these financial statements a little bit, so I'm not going to go into each one in too much detail, but here's the three basic financial statements, and then I've got an example of each. So your balance sheet just has to balance. So I used to have an instructor I had in grad school or in my undergrad, and she would always end the class by saying, and our balance sheet balances were happy little accountants that get to go home tonight. When I got to grad school, she didn't say that anymore. And I asked her why not. She says, well, by grad school, you probably have some work experience and you know it's true, and I just don't want to twist the knife. So it's very simple. All your assets, so that's everything you own, everything you have a right to that's going to provide you with future value. Your cash, investments, your property and equipment, any intangible assets like internally developed software that you have. And then the bottom half of your liabilities and your equity, how did you fund that? Did you fund it with debt that you have to pay back? Do you owe payables to your vendors? Or did you bring in equity from stockholders and maybe you're going to owe them future dividends or payouts? Anybody have questions on the balance sheet before I go on, or anything else up to this point? Okay. So the next is your income statement. Pretty straightforward. It's just your money in minus your expenses out. And again, this might not be the same timing as your cash. And so if Dave were here, he would start talking about the cash flow statement because I swear this is his favorite thing in the world. So I will try to do him justice. And what I like this, it marries the balance sheet and the income statement. It tells you what really happened to your cash during the year. And as a new company, there is nothing probably more important to you than your cash. So it's just saying you had some net income or you had a net loss. It backs out anything that happened on your income statement that wasn't cash. So you might have some depreciation on your fixed assets, maybe some stock-based compensation. And then you're going to have all your change in your balance sheet accounts that brought in cash or took cash away. So did you collect on accounts receivable, or did your accounts receivable grow during the year and that's someday going to be cash to you, but it's not yet? Do you have payables that you still need to pay? Did you buy inventory? Did you sell inventory? All comes into your net operating activities. And that net operating activities, that's really what tells you the day-to-day operations of your company make money or lose money. And if you lost money, you probably had to bring it in through either investing or financing. So most of it comes through as financing. You get some equity in, you borrow some debt, and you get some cash from that. And then that takes you to your change in cash. You add that to what you had last year to get to your ending cash that ties back to your balance sheet. And again, you want to look at this so carefully to know where your cash is going, and it can help you plan. If you know, hey, I'm losing money this year, I'm probably going to lose money next year because we're still in startup phases. Okay, how am I going to pay for that? So again, like I said, cash is king. You have got to monitor this. I can't tell you how many times I've sat in a room with companies and they're trying to figure out how they're going to pay their payroll tomorrow. They've got to hit that submit button on their payroll and they're like, where is this coming from? Is an officer going to put in a loan to float me? Instead of thinking out 6 months, a year, 2 years, okay, how much cash am I going to need in the future? I've got to start bringing that in now. What are the timings of my cash inflows and my cash outflows? So if I sell something to my customer, how long till they actually pay me? Some of that's going to show up on your balance sheet. Some of it's just going to be cash out on your income statement, your day-to-day expenses, your office supplies, everything like that. Marketing can be expensive in the beginning before you really turn around an investment on that product or that service that you are selling. So, financials are great. They can tell you your bottom line, your income, did you make money? But then you look at what can these numbers tell you beyond what's really in those numbers. And this is, in accounting, this is where it gets fun to me. This is where I get to turn it into something extremely meaningful to the business owners that I work with. What is their cash burn rate? Some of them think, oh, I've got cash that's going to last me 2 years. It's fine. But when I start running their run rates, I'm like, no. In 3 months, you're going to run out of cash at this rate. So what can we do to either slow that cash flow down or bring in more cash sooner than you were planning? Your AR collection times, from when you sell a product or service to your customer, how long does it take you to actually get that money in the door so that you can plan for that? Not how soon you want it to come in, but how soon is it really going to? If you've got inventory, when you buy that, how long does it take you to sell that product? Is it a quick turnaround, or are you going to have to sit on that and pay for it? And it's going to be 6 months or a year till maybe some of that is sold. Your return on investment. That's what your investors care about. What is their return on their investment? When you go in to get money, that is what everybody is going to ask you. What's their return? How quickly do they get it? What percentage? That's what your financials can tell you. Your customer acquisition costs. How much in marketing and overhead and everything else that you have to pay does it cost you to bring in that one customer that saw you on Instagram or wherever they saw you? What is that really costing you, and how can you get that cost down? What's working? What isn't working? Your gross profit. And this one's important, not just to know like how much are you making on your sales minus your whatever your cost of your goods sold is. How does it compare to industry averages? If you're doing something better than your industry average, what are you doing that's special? How can you make that even more of an advantage to you? And if you're way below the industry average, again, why? Are you not selling your product for enough? Are you buying your basic goods that you're selling for too much and you need to lower that somehow? Your net income, are you making money? And your break even, when are you going to start making money? How long are you going to have to lose money before you start earning a profit? Your fixed versus your variable costs. Your fixed cost is something, if you stopped business tomorrow or if you didn't grow, that cost wouldn't change. So if you've got a lease on a building, you stop tomorrow, you still have to pay that lease. Things like that. Or your variable cost, maybe your payroll. You know, unfortunately in tech right now, there's a lot of layoffs because they're saying, hey, we can cut this variable cost tomorrow. So you've got to know. And so if you're considering, going out of business or changing something, you need to at least make sure you're covering your variable costs. Because then at least you're covering those that's making that money, because you're going to have your fixed cost no matter what. And then sunk costs versus opportunity costs. In theory, sunk costs are the easiest thing in the world. That money's dead. It's gone as ancient Rome. You don't think about anything you've paid so far when you're looking forward and deciding, are we going to continue with this service line or this product? You don't look at what it's cost you in the past because you can never get that back. In reality, it's going to be running through your head. I put all this blood, sweat, and tears and money and investment into this. I can't just stop now. That's what emotion is. And so it's really trying to take that emotion out and just saying, look forward. And then as you're looking forward, what are your opportunity costs? You only have certain resources. So if you put your resources into this, what could they be doing for you instead? And is that going to have a better return? Is that going to help you achieve some long-term goal that you've got for yourself or your company? That's kind of it for that part of the presentation. Any questions so far? Anybody? Yes. Yeah, I think we can make them available. Yep. So just for the women in the room, we are doing a women's, I hate to say networking event because I don't know, that just kind of comes with certain stress, I think, especially for women. We do these fun evenings once a quarter, and they're just fun to get together, hang out. So if any of you have interest in attending our next one next month, there's a little bit of information about it. And then I will just kind of go into our wrap up to our final thoughts and last things to be thinking about. Your accounting and your reporting is so vital to your company. You don't want to be figuring out what happened to your money as you're running out of it. You want to have those numbers up to date, giving you the ability to look forward. Look at what's happening. How is that part of your strategic plan? Know your financial statements. When you walk into anytime you're trying to get money from anyone, they're going to ask you questions about their financials. There might be times you don't know the answer, but you want that to be as minimal as possible. You want to know those better than anybody. Know your metrics, know your ratio, so that when you're asked, you can answer that with complete confidence. Ask your accountants questions, leverage them, learn what you need to learn from them to go into these meetings very confident. And this is what I like to always tell clients when I'm looking at their financials and they're saying, well, it's just going to work. It's just going to work. If I can't get it to work on paper, it's not going to work in real life. Okay, if your expenses are just more than you think they are, or your revenue's not where you want it to be yet, you need a plan to get it there. It's not going to magically work out, unfortunately. And then again, I want to end on know your internal controls, establish them, maintain them, control your money, not like a control freak, but know where it's going, understand it. Don't let somebody else just walk away with it. That's all I've got. Any other questions? Any comments? Anything? Okay. Well, thanks, everybody.
Thanks, Satori. Next, we have Darren Pearson with Tanner, and he's going to talk about entity selection.
Oh, yeah.
up next, we have Matt Neuenschwander. And from a marketing standpoint, which is what I focus on at Tanner, it's a great practice because it's the one that we can say it puts money back to your bottom line. So, and I wanted to just reiterate, we have lunch from R&R Barbecue, and Garrett with the Texas Drawl over there, and another Tanner partner, Sean Marchant's here, along with the people presenting. So it's designed so that you can stay and have lunch and ask questions in a more casual setting.
All right. Hopefully this is on. You can hear me okay. For tax credit incentives, we want to talk about different strategies that you can use to offset some of those tax expenses that you might have. And so there's a little bit about me if you want to go back and review that. So agenda for today, we'll talk a little bit about the research credit. And so one way that you can offset tax expense. Some new rules related to R&D cost capitalization under Section 174. And so that changed for tax years beginning in 2022. And so that can be very relevant if you have development costs that you've historically been expensing. There's some changes based on current law. We'll talk a little bit about the payroll tax credit and how you can use your R&D tax credit to offset payroll expenses that you may have. And then we will touch briefly on, sorry, one slide ahead of you. No, we're all together. The employee retention credit, just because that is it's actually only applicable for 2020 and 2021, but if you haven't claimed it, you can go back and amend. And so if there's any questions on that, just want to make sure we cover it. So with the research credit, it is an activity-based determination. And so what you do, not necessarily who you are or your type of business. There is some documentation of what you're doing and the related expenses that are required. And so the number one reason for disallowance would be a lack of documentation related to what type of development activities you were doing, why was it technically challenging, what type of iteration or testing was required. And so that's often what the IRS is going to look at if they were to audit a credit. You can claim the tax credit, the R&D tax credit for open years. So let's say you've started, you've been in business for 3 years in losses just because you've been in that development R&D phase. And then now you're looking at projections and you think you're going to have some tax expense. And so you can claim the credit for the current year as well as amend prior years or adjust your carry forward to claim it when you have that tax expense. There is a little bit additional documentation that's required if you're amending your tax return to claim the R&D credit. The IRS wants to know what type of business activities or business components, products that you were developing, who was involved, what was their role, and so there's some additional documentation that you'll submit with that. The credit or the dollar for dollar offset is generally going to be a percentage of the expenses. And so a good rule of thumb is it's going to be around 7 to 11% of your spend. So if you spend $1 million on development, you're probably going to have between $70,000 to $100,000 in a tax credit that you can use. Most states also offer an R&D credit, and most of them follow the federal rules. And so Utah, for example, has an R&D credit that's available to offset Utah tax. And generally, it's around that same range. Sometimes a little bit lower. Utah is a little unique because they have actually 2 credits that could be up to 12% of your expenses, but only a portion of that will carry forward if you don't use it in the year it's generated. So how do you qualify? The 4-part test that accountants generally will refer to relate to 1, are you developing new or improved products? Is there a process of experimentation that's required? So engineering, physical sciences, chemistry, computer science will all be a hard science that would qualify. Is the research intended to eliminate uncertainty as to either the capability, the methodology, or the appropriate design? So are there technical hurdles at the beginning or during the development process that you need to resolve? And do substantially all of the activities constitute elements of experimentation? And so if you're evaluating alternatives, building a proof of concept, prototyping, kind of that systematic trial and error, Those would be all examples of uncertainties or a process of experimentation to resolve uncertainty. Types of activities that don't qualify, and so non-technical research. And so how do we price? Is there a demand for this product? How do we best market our product? That would be non-technical, so that wouldn't qualify. If it's funded by a third party, and so someone's paying you to do development on their behalf, they own the IP, that wouldn't be your research, it would be theirs. Internal use software, if you're building software to run your business, so do the accounting or the human resources or that type of software, there's a higher criteria in order to qualify that for the research credit, because the IRS doesn't want to incentivize companies to create their own version of QuickBooks when you can buy it off the shelf. And so internal use software is a little harder to qualify for the research credit. And then if the development is performed offshore, so if you're using offshore contractors to do the development or assist in the development, those expenses aren't going to qualify for the credit. Go for it. Yeah, if it's related to work performed offshore, it's still not going to qualify. And so even if you own a development or you set up an entity in India, you have development going on there, the expenses there aren't going to qualify for the credit. So it's a U.S. credit. It's basically set up to incentivize companies to keep development in the U.S. And so those expenses in a foreign country aren't going to qualify, at least for the U.S. research credit. Yeah. Yep. Because the client's paying you for, sorry, say that last part again. Right. So from what I'm hearing, and we can talk about it offline, the development would be building the software, the tools to run those analytics. And so if you've hired a developer or a data miner and you're doing, here's AI and it's going to tell me how, it's going to give me a measure of success for a podcast on this topic or for this company. So the cost related to developing that technology or the software or the tools to run that would be your R&D cost that would likely qualify for the credit. And so the types of expenses that are eligible, which we kind of got into, wages. If you have any supplies, generally that's not material for software. If you have computer rentals, so you have a hosting environment or a test environment, and then contract research. So if you're paying a third party, someone through a 1099 to do development, you can use 65% of that amount paid for the research credit. So those are your eligible expenses, and then the credit ends up being a percentage of that total cost. Just to get into a little bit more of the details, so for wages, it's going to include the amount paid for qualified services, so performing those activities, whether they're directly performing, supporting, or supervising. And so qualifying departments generally are going to be your research, R&D, engineering, maybe QA, maybe some product management. If you have admin or executives, depending on how involved they are in the development process or generating ideas, they may have some development, manufacturing. If you're building like test batches, you could have some qualified expenses from that department. So I'm going to jump into kind of the capitalization of R&D expenses. And so beginning in 2022, R&D expenses are required to now be capitalized for tax purposes and then amortized over either 5 or 15 years. It's 15 for non-US R&D. And so that's going to apply whether or not you claim the R&D credit. If you're developing new technology, you're required to now capitalize costs. And you can't accelerate the depreciation or the recognition of that cost if you abandon or sell or determine that it's worthless. The book the R&D expense under 174. So there's two sections. You've got 174, which is all of your R&D costs, and then within 174, that pie, you've got section 41, which is credit eligible costs. So for the credit, it's just going to be your W-2 wages, supplies, 65% of contract research, and any materials. And hosting costs, I think. Supplies. Whereas 174, that bigger pool, is going to be all of your R&D type department costs. So 100% of the wages, the foreign research that doesn't qualify for the credit, it's going to go under this section 174. A certain amount of your indirect costs, so if you have utilities or rent expense, and 20% is related to the R&D group, that would go into these capitalized costs. So this amount that you capitalize for R&D expenses can be larger than the R&D credit expense. And I've got an example here. So company has $1 million in revenue, $750,000 in R&D expenses, and $500,000 in other expenses. And so under these new capitalization rules, the company would report taxable income of $425,000. So that's what I've got over here. So if you have the same revenue and expenses in 21 versus 22, you might have no expense in 2021, but you'd have a tax expense in 2022, just because your R&D expense, you can't deduct, you can't take that full 750 now. You're going to take a percentage of that. And so the 75,000, it's generally over 5 years, but for the first year, you only get half of the depreciation. And so that could create a scenario where you're operating at a loss because of all your expenses, but you have taxable income because of this change in the law. So something to be aware of with R&D expenses. And so there are some things that you can do to plan around that. And so let's, again, continue that example. And so for 2021, we're going to say, hey, we had a loss, a taxable loss of $250,000. That created an NOL carry forward. And so for 2022, we're still at that taxable income. We have some expense. We can use a large portion of that NOL to offset the tax expense because we had a loss in a prior year and that's carried forward. Maybe we also offset a portion of that expense with an R&D tax credit. So instead of paying $90,000, we're paying around $5,000 in tax expense, kind of with that scenario. So just something to be aware of. That's a change for 2022 if you're developing software that need to be capitalized. All right, let's get back to the good news. So payroll tax credit, there's an option for startups in their first 5 years of revenue to use R&D credits to offset their payroll tax expense. So you use the same rules to determine if you qualify for R&D credits, and then you check a box or make an election to say, hey, I'm not going to use, I'll back up half a second. So for R&D credits, you can only use that if you have tax expense. Otherwise, it carries forward for 20 years on the federal. And so for a lot of companies that are in losses or just in startup phase, they're not going to be using that R&D credit until they have tax expense. And so Congress, I guess, to help small businesses or startups said, hey, we know you're not really using these R&D credits because you may not have income for a couple of years. And so we're going to let you use your R&D credits to offset payroll taxes. And so the, Social Security or Medicare taxes that you likely are paying on behalf of your employees, you can use your R&D credit to offset that. So that's one way that this payroll credit provides a benefit for small businesses. Again, we're going to qualify under the regular research credit rules. There are certain requirements, so you can't have gross receipts in excess of $5 million, and you can't have more than 5 years of any type of revenue, whether that's interest, dividends, or sales. Again, kind of define, gross receipts are any type of gross receipts. So it kind of starts a clock. So once you have some revenue, you can claim the payroll credit in that year as well as the next 4 years after that. After you've had 5 years of revenue, you no longer qualify for payroll tax credit. It says up here you can claim up to $250,000. It's actually $500,000 now. They changed that as part of the IRA Act that came out last year, and so you can use a larger percentage of the credit used against your payroll. If your R&D credit is in excess of the amount that you use, or you only want to use a certain amount for the payroll credit, just indicate that in the election how much you want to use to offset payroll taxes. If you don't use it in your first quarter, it rolls forward until it's fully utilized. There is some coordination with the payroll provider, just so you know. Hey, we filed this tax return. We claimed an R&D credit. We've elected to use $100,000 to offset payroll taxes. Let's make sure that's reported on each quarter of the 941 until it's fully used. Any questions on payroll credit or R&D credit before we move on to the last topic? Yeah. Right. Yeah. The sweat equity, not really. There needs to be some type of either guaranteed payment or something that's subject to Social Security taxes in order to claim a credit on the expenses. And so, yeah, I've seen deferred wages. You just pick it up in that period when it's paid out. So I had one startup that didn't pay the owner for 4 years and then got a big lump sum, $300,000. So we took into account what wages when they were kind of deferred and what percentage of their time was related to development in those early years to determine what percentage of that total wage when it was paid qualified for the credit. All right, so doing okay on time. Employee retention credit, that came out of the CARES Act. I won't spend too much time, but it's basically a way for companies were encouraged to keep employees paid during the pandemic. And so to the extent that they were subject to government orders that shut down their business or they had a significant reduction in gross receipts, they'd qualify for the credit. For tech companies, most of the time you could work from home. And so work is pretty portable. If that's the extent of the disruption to your business, probably not going to qualify. I'll hit on some of the bullets here, but originally, if you claimed a PPP loan, you couldn't also claim PRC. They changed that to say you could claim both. You just couldn't double dip on the same wages. For 2020, it's up to $5,000 in credits per employee. And in 2021, it's up to $21,000, essentially $7,000 per quarter. You claim it on a payroll tax return, and you can amend those returns for up to 3 years. The eligible employer, again, I kind of touched on was, you become eligible for this credit if you had a significant decline in gross receipts. So you had a certain amount of revenue in 2019, and it dropped 50% in 2020. You're looking at it on a quarterly basis, or a 20% decline between 19 and 21, or your trade or business was subject to government orders that suspended operations. So you weren't able to go out or you weren't able to open a location. I think a lot of these, the easy example would be like a restaurant. They couldn't do in-person dining, but they could still do takeout. Or if you were a salon, you had to close down. There is one other bit classification to qualify for the credit. It's called the recovery startup business. So did anyone begin their trade or business after February of 2020? One person maybe. And so if you did, you automatically qualify for the employee retention credit. The benefits up to $50,000 per quarter for 2021. So if you haven't claimed it, let me know. I can give you some more details, but that's probably the most applicable for tech companies. If they started business, they just automatically qualify for that. Again, we're going to compare quarters in 2021 or 2020 to the same quarter of 2019 to look at the reduction in gross receipts. You need a 50% decline in 2020 or a 20% decline in 2021. And then you look at eligibility on a kind of rolling basis. So you compare the current quarter and then the next quarter to see which quarter you qualify in. The government orders or the disruptions, they need to limit commerce, travel, group meetings, etc. depending on the size of your company, whether you're 100 or less employees, change what wages qualify for the credit. And so examples of valid suspension of operations, if you're a manufacturer and you weren't able to get critical materials or supplies because those suppliers were shut down, if you've got multiple operations and in, let's say, California, you were subject to a certain restriction that you couldn't operate, or if the workplace is closed for some operations. Invalid suspensions would be like, you just your customers had to stay at home, and so that reduced demand, but you were able to continue operating. If you voluntarily close, if you're just making modifications to alter customers' behavior, and it's not more than a nominal effect on either revenue or hours, or if employees are able to continue operations in a comparable manner from home. A couple factors to consider when determining if you had a suspension of operations. The qualified wages based on the amounts paid, basically the wages subject to Social Security tax. Again, maximum amount of wage qualify for each employee in 2020 is up to $10,000, so the credit is 50% of that, $5,000. For 2021, it's a little bit more lucrative because the maximum qualified wages is done on a quarterly basis rather than an annual basis. So it's $10,000 per quarter, and then the credit rate is 70% instead of 50%. There's certain exclusions for wages if you use basically no double dipping, doesn't count for contractors, or if you receive a PPP loan, you can't use the wages that were offset by that loan to get ERC. So there's a quick comparison of 2020 versus 2021. Again, some of the definitions change, the amount of wages that you can qualify and the percentage of credit. All right, so summary real quick. Research credits can often provide, research credits often provide larger tax credits utilization limited to income tax liability. There are some new R&D capitalization rules to be aware of for 2022. Payroll credit allows companies to utilize the research credit to offset their employee taxes, and the employee retention credit is fully refundable but limited to eligible. Mary, are we going to take a quick break for snacks?
So we have a quick break now, and then we're going to be joined by Arian Lewis, the CEO and founder of Kiln, when we get back. And then to finish out the day, we have our always entertaining John Pullman that runs our security practice, and Braxton Savage and Mark Erickson to talk about the transaction. Oh, and there he is. We're going to do that first. Hi, Arian. How are you?
You guys have been here already this morning, right? It is sort of working? Well, hey, welcome. How many of you have been here before? Okay, wow, a lot. How many of you are members? Okay, only a few. Well, then the rest of you have a lot of opportunity because you can all still join. What do you know about Kiln? So where's the furthest away Kiln location? Any guesses? Does anybody know? Provo's a little close. San Diego, definitely. So I think the furthest away is our Solana Beach location. So Kiln has 10 locations. We are a Mountain West focused company, or West and Mountain West. So any place that you'd love to visit in these states, that's where we want to be. And we're a lifestyle brand. This is a bit of sort of an odd thing for something offering real estate to consider itself a lifestyle brand. But when we think about our mission, what we're really here to do is actually elevate the quality of life while you're at work. And I feel like that's one of the major insights that all of us kind of gleaned out of this pandemic was like, how is life and work really correlated? And for a lot of us, we learned that, well, actually we can do work at home. We can kind of experience parts of our life and merge them a little bit with work. We also probably learned, and you're here in person, that there are some things that are really most effectively done when you're in person. And those tend to be the moments when really important things happen in a business. When ideas are, formulated or agreed to, when important relationship things are sort of worked through. I've been thinking recently a lot about recovery in a family, right? So we all have families, and we know that our ability to sort of recover from things when a difficult thing happens is part of success in a family, and it definitely is part of success in any company, particularly young companies that are going through a lot of change. How many of you are founders? Okay, great. So the most important thing to all of us that are founders is our team. And one of the things that's really interesting about Kiln is that Kiln is actually, we're doing some research now, and we've done it in the past as well. We've been able to show that a normal team will save about 5% on HR costs by being at Kiln. And the reason for that is that your ability to attract, retain, and recruit improves by having an environment that is really appealing, especially if you're not offering a lot of equity. So sometimes when you're hiring folks and you're a startup, you're incentivizing them through equity. But if you're hiring particularly younger, millennials or folks coming right out of college, and you're not incentivizing them through equity, it's the whole package. It's how Instagrammable is my job, how dynamic is it? Do I get opportunities for learning and development? And that's where we're really going to be a strong partner to you as a founder. I will just pause there. Do you have any questions? Anything you want to ask? Yes. Sure. Yes. Totally. Great question. Okay, so our basic membership, which is not very basic, it actually includes almost everything, meaning you get 24/7 access, access to all of our meeting rooms, all of our events, everything, is $250 a month per person. Yeah, so $250 a month. It's a great thing if you're a work from home team, but you want to have access to Kiln on a few days a week. Then we go up to 2-person offices, which range from $900 to up to sort of $1,200 in, say, Park City. But don't try to get on the list in Park City because it's like 50 companies deep, believe it or not. Crazy. Yeah, but yes. And by the way, with a club membership, you can go to any Kiln location anytime. So you have an app, you can book a meeting room in Salt Lake or in Park City or in Solana Beach, which is pretty awesome. And then we also offer, private offices of a variety of sizes. We have a team right now with us that's an 80-person team. It's a Microsoft-backed company called Go1. Does anybody know Go1? Anyhow, cool company based out of Australia, but they have a team of 80 people with us in Salt Lake. How many of you have been to the Lehigh 2 location next door? Raise your hand. Okay, so not as many people. There is a beautiful kind of brand new floor and product next door. And if you were to go to Park City, you'd actually see like version 3. So this is like version 1, version 2, version 3. You'll see that Kiln as a product is evolving. And a lot of people don't know this, but we actually design and manufacture over 20 different products. So now we have manufacturing partners in Mexico and here in the US. And a lot of the things that you touch and feel here are actually designed and manufactured through our partnerships. And design. And we have a team of designers that are continually evolving those products. That was a great question. Any other questions? Yeah. Yes. Yes. Okay, so in Utah, should I just touch on Utah? So we're building in Provo right now. It's super cool. Amber is our community director for Kiln Provo. And we have signed a deal for St. George, and we will go under construction there in a few months. Both of those locations are actually brand new buildings that we're building from the ground up, from scratch, almost like a whole product in and of itself. in the coming 24 months, I believe we will be able to announce another location in Park City. We are looking at Heber. It is tough, and it's trying to find the right size and just even availability of the right space there. But it's definitely something we've been thinking about. And there are a few other markets along the Wasatch Front. I'll say I think there's going to be another one between here and Salt Lake at some point. So yeah. Oh, thank you. For those of you that are founders, I'm like on a high today. We just closed a round of funding this morning, which is really exciting. Thank you. And if any of you are trying to raise capital right now, you know that's hard to do at the moment. But it feels really great to have tied the bow on that one. So, any other questions? And yeah. I'm so glad you asked that question. Okay, so I'm just going to give you a tiny bit of background. I know Adam Newman and Miguel McKelvey. I built a co-working brand in London that had locations in London, New York, Tel Aviv, Cape Town, South Africa, Mumbai, and Vilnius, Lithuania, and Manchester, England. And I moved from London to New York and worked in co-working in New York City, which is where I actually got to know Adam and Miguel in 2011 when I was studying co-working as a graduate student. I was living in London, going to school in the UK, but was studying co-working and met them at that time. And Adam and Miguel did an incredible thing. How many of you have seen the TV show, We Crashed? Okay, well, if you haven't, you really ought to, because it's really, really good. And he just raised another round, which is the largest in the history of Andreessen and Horowitz, 350 million seed round, if you want to call it that. Pretty crazy. So their philosophy was like, how do you build space that A, makes it possible for people to not sign a lease, and B, like maximizes the utility of that space. And so I sat with them and just talked through their whole philosophy a couple different times. And ultimately, it came down to they were going to target highly dense urban markets where it was really difficult to get access to space and where you could introduce their model, and they chopped it up into little blocks and basically you could get access to it. So think of space optimization as the primary goal for those companies. And they think of themselves as now, especially as a real estate company, right? Kiln is really looking at it through a different lens, which is how do we optimize lifestyle and performance through a physical environment. And so I'll just give you a few stats. WeWork traditionally builds at a rate of about 50 to 55 square feet per member. Now that's not perfect. Like you wouldn't, it's a little hard to explain what that really means, but just think of that 50 to 55 square feet per member. We're typically building at about 75 square feet per member. WeWork margins are generally about 50%. Our margins are generally 20, and if we're really rocking, we get to like 25%. What that really means is that a WeWork model is designed to really focus on the utility and the function of the space. Our model is banking on retention and the quality of what we offer to our members as being the primary driver of the model. And if we can just maintain good occupancy, the business functions well, and by the way, I've never actually told that to anybody. Like, so please don't post that, or please don't post or anything. But we're in a little circle of trust here. But that's the answer, really, is that our motives are really about retention and about quality of life. And if we do that well, we can make a reasonable profit. Whereas on this side, they can like go crazy on profit. I mean, a 50% margin on real estate is insane. But in places like New York, where they had a corner on the market, or other places, they really were achieving that. And they were very profitable in many of their locations. The problem is they grew too fast, and they didn't have good corporate governance. And it just ended up, they just got over their skis, basically. It's kind of like if you ski really, I took this girl skiing when I was 16, and bless her heart, I feel so bad about this. I really liked her, and we got her on too long of skis. Her bindings were too tight, and first run down, she blew her knee. And I mean, she was on the track team, and it was just horrible. And I just remember feeling, and she was a cute redhead. At any rate, the point is, that's what happens in businesses sometimes. And it's better that we just take it slow, shorten the skis, loosen the bindings, and just take it at a nice pace. So Kiln is never going to be like doing 800 locations or something like that. We're going to do a nice steady growth into markets that we genuinely love, like places that we would want to be ourselves. That's our mission. Thanks. I feel like I've taken too much time. Am I okay? Yeah. Question? Yeah, community adjusted EBITDA. Yeah, if anyone knows what that's all about. I will tell you, I've looked into that in quite a bit of detail, and it's very interesting because at the end of the day, if you don't allocate the square footage to it, you can't actually create a lot of community. And that is, if you go to our new locations, you'll see an evolution. This is a phenomenal location. It has tons to offer, but we've now been able to offer a lot of what happens here in a much smaller footprint. So Park City is only 24,000 square feet. This is 48,000 square feet. And we've managed to squeeze in to 24,000 square feet a lot of the community things. Like we don't have a big theater, but we have an atrium. You'll have to go see it. But at any rate, a lot of the things that make a community thrive, we figured out how to like put them in different sizes of boxes. The other difference between WeWork and Kiln, just as a side note, and Industrious and Regis, et cetera, 90% of their spaces are in office buildings. Two of our 10 spaces are in office buildings. All of the remaining spaces, 8 out of 10 for us right now, are in retail, old retail spaces. And so we love taking on like a bowling alley or we're working on a movie theater place right now and other spaces that need to be reborn, I guess. Yeah. Yes. Yeah, I mean, I think that the whole reason we come to work has changed. Not that it was ever different, but that it wasn't clear to us. Like, you don't have to have a desk in order to do a job. So you don't come to work for a desk and a chair. You really come to work to have meaningful connections, to increase the productivity of what you or your team are trying to accomplish. There's 2 or 3 other really important reasons, and I'm going to say this. Last year, 1 out of 3 Utahns reported being lonely and having that being associated with anxiety. 1 out of 3 people in Utah. We're like the happiest state in the union. You know, the truth is that we genuinely do need each other, and there's a real mental health thing that goes on when we just feel a sense of belonging and a sense of being able to be a meaningful part of somebody else's professional or personal life. So I will say that I'm really interested in offices of the future that don't have desks, don't have chairs, and that are really about enabling strong points of connection, maybe 2 or 3 times a week. You know, that's one thing. So right now we build most of our spaces with a lot of desks. I think that'll change. I think the second thing is that you can really only be at one place at one time. Digitally, we're like, you guys are probably active on 5, platforms right now, and people can connect with you through Slack and email and LinkedIn, and it's annoying and it's so much. But in person, you can only be connecting with one person at one time. Now, we want to make sure that our meeting rooms and the way that we think about meetings is very different than the way we were thinking about it 3 years ago. The in-person connections really need to be very dynamic and probably with a level of hospitality that we haven't had previously. But the next thing is, we probably should never build another meeting room again. We should only build film studios in which you can have an amazing meeting. And what I mean by that is we actually need the physical environments to really be ideal for also the virtual connections, because it is so annoying to be on the virtual end of a meeting happening in person and feel like you're trying to get a word in edgewise, or the lighting sucks, or the sound isn't good. And so a lot of our investment going into the next 24 months is going to be in the audiovisual side. And like I'm connecting with movie and film producers and people that are going to look at meetings through the lens of like, well, if every meeting is a TV show, then how do we make sure that every TV show is something you'd actually want to watch? That makes sense? Okay. I've probably talked too much. Anything else? Yes. Yeah. It's a great question. So on Wednesday, I'll meet with a good buddy of mine in New York named Dan Zakai, who's the founder of Mindspace. They have 40 co-working locations. And yeah, we absolutely are looking at those things to give our members access to a larger network of locations. We just haven't figured those out yet. I mean, what's kind of cool now is that we have enough density in Utah that there's a pretty good utility function. Like you can run a meeting, in a few months, you'll be able to run a meeting in Provo and then zip up to Salt Lake and attend something up there and use Kiln in a sort of a more multifaceted way. But yeah, we will expand the network as well. Yeah. Co-working is sort of being reborn right now because 800 co-working spaces went out of business during the pandemic. And I'm proud to say that we cut costs and we had to get really efficient. We did not lay off any team members and we did not miss any payments during the pandemic. So thank you so much. If you want to learn more about Kiln or have a tour, any of our team members at the front would be happy to show you. Again, if you haven't seen what we've done on the 5th floor next door, it's definitely worth it. Thanks.
Thank you so much. Okay, time for a break and a snack, and be back in about 10 minutes.
So can you hear me back there?
Last up, Braxton and Mark. This is the one that everybody wants because this is when you're about to exit. You've done all the, oh, sorry. You've done all your work. You've been building, and got your clean accounting and your great security and followed all the laws, and you're about to have an exit.
So yeah, no, we're really excited to be here. And thanks for sticking it to the end. It's impressive, especially right before lunch. I know the polls start to kind of come in and say it's lunchtime. Let's go. But Braxton and I want to spend just a few minutes talking about your actual exit strategies and exit plans. So looking ahead for a potential transaction, a potential sale of your business, a potential merger. What does that look like? What are some things you can do now? What are some very critical steps you can take to make sure that process goes smoothly? That's what we want to cover. So Braxton and I head up what we call our transaction services group at Tanner, and we consult with companies all day, every day on transactions. So we represent buyers, so private equity firms or companies that are looking to buy other companies hire us to provide financial due diligence, financial consulting in connection with acquisitions of companies. And on the other hand, we are also engaged by companies that are looking to sell. So we refer to those as buy-side and sell-side engagements. So we do about half and half. We do about half, at least last year we did about half working with companies that were looking to sell, and about half representing buyers that were looking to buy. So we've seen a lot of transactions. We've seen a lot of issues. We've seen a lot of incredibly good closings of transactions, so really successful exits. And we've seen a few fall apart. So I think we've seen a good range. I think right off the bat, and Braxton, I'll start really quick so we can hit this, and it's probably somewhere down the line on the slides. But first and foremost, I wanted to, I think maybe highlight some of the key areas that we have seen where companies run into problems that can derail their transaction, derail their deal, and cause things to fall apart. And I think there's really just a few of these that stand out. From our perspective, one of the big ones is the quality of the accounting record. So we get it. Small businesses start out, they're weighing cost benefit, trying to decide, how much do we invest in an accounting system, in an accounting team. Maybe we're okay accounting for things on a cash basis because that's kind of how I want to run my business, and that's the information I need. That's all fine. But when you start walking up to a transaction, I can tell you right now, in almost every circumstance, the buyer and the buyer's team are going to want to see, they're not going to want to see cash basis financial statements. They're going to want to see GAAP basis financial statements. GAAP is generally accepted accounting principles. It's an accrual basis of accounting. They're going to want to see that. And this is critical, they're going to want to see it monthly. And we've run into a lot of companies where, maybe at year end, they do a good closing. They close the books and do a good job at year end. Everything's good. Maybe they book their year end accruals and so forth. And so they got good GAAP basis financial statements at year end. But then when we go to get monthly statements, it's a real challenge. So I'd say that's probably number one in as far as difficulties and challenges that we've encountered is companies that don't have a good month-to-month accounting process or accounting system. And keep in mind, there's a lot of stuff you can fix, but it takes time. And so, yeah, you can run the cash basis. That's cool, no problem. But the closer you get to that transaction, the sooner you want to jump in and get a system in place where you can generate those GAAP basis financial statements. When it comes time for the transaction, if you're trying to go back in time and do it all, it becomes a painful process, or it can be a painful process. Second item is we've seen a lot of sales tax problems that they don't necessarily derail the deal, but a lot of times they can delay the deal, because a company will say, well, we're just a Utah company, so we pay sales tax in Utah. We don't pay anywhere else. Well, as I'm sure you're all aware, sales taxes are a lot more complex than that. We've seen companies that thought they only owed sales taxes in Utah, but in reality, they owed in pretty much every state. So that can become a real challenge, getting compliant with that. A buyer, and by the way, you definitely want to identify that problem before a buyer identifies that problem. If a buyer comes in and identifies the problem, and then you got to go get it fixed, it's gonna cause some problems. The third issue I'll mention is, I think just making sure that you have hired good, strong, professional advisors. Some people decide not to hire like an investment banking firm because they think, well, I kind of already know who I want to sell to. I've got this company out there. I think I want to sell to them. They've expressed interest. I think it's a good deal. We'll go with that. And we'll save this money on not hiring, an investment banker or all the attorney time and things like that. That can work, but I'd say it's a little bit of a gamble. And my advice to companies is be really, really careful. And generally, my feeling is hire competent advisors that you know you can work with. And I'd say in 99% of the time, it's going to pay off for you. The increase in the purchase price that you will get will more than pay for those advisors that are going to come in. So, what else would you add, Braxton? Those are kind of my big three. Do you have anything to add? And Q of E is a quality of earnings report, is what that stands for those of you that may not know. Quality of earnings report is a report that we put together, and it basically summarizes all of the financial analysis and due diligence that we do and puts it in a report format that sellers can then, and their investment bankers can then take to the market to either raise funds, as Braxton was saying, or in a sale transaction. So I think we had a question. Great question. You're exactly right. It is, you're as a business owner, especially for a new organization, you've got a lot of things pulling on both your time and your money. And so you have to make a lot of judgments on a daily basis. Where do I allocate my time? Where do I allocate? And yeah, you're totally right. And that's why I was saying, definitely early on, I think, yeah, it helps if you don't make huge errors. But if you think, hey, we're just going to operate, we're going to keep the books on a cash basis. It's simple. Cash comes in, we book revenue. Cash goes out, we book expense. Piece of cake. That's how we're doing our taxes anyway. It's all good. That's okay. That's totally fine, because it's unlikely that you've got a sale transaction pending and coming up in the next 6 to 18 months. It's a little further down the road. As your business matures, and as you get your feet under you, and maybe you expand your staff a little bit, you have some resources to build out your team, I think definitely those are good times to start to think, okay, where are we at here? How far away is a potential transaction? Are we 3 years out? Are we 5 years out? Are we 10 years out? Where are we? And depending on that decision, then you can start to look and say, okay, let's say we're 3 years out. Is now the right time to really start to make this a much more robust process? Something that it's going to take some money. Maybe we need to hire a more competent person that can do our accounting, a higher level person that has deeper skills. Maybe we need to invest in our infrastructure, our IT and accounting system, so that we can generate information on request really fast. It doesn't take a ton of time. So those are definitely decisions you got to make. And I think there isn't a hard, fast answer to that, though. There really isn't. I will say, as you start to consider and as a business owner think, okay, I think my exit's 3 to 5 years away. I think that's a great time to really start thinking about it seriously. Most of the reports we do, we are reflecting 2 years, two calendar years of information, and then maybe a trailing 12-month type deal. So, for example, right now we're close to year end, so we're doing 2022 and 2021 data. Once we get a couple of months in, we do 2021, 2022, and then a trailing 12 months of data is generally what we would do. So that's only 2 years back that you're looking for a transaction that's happening right now. And so for companies that started that process, maybe got it in gear 2 years ago, had a pretty good system in place, it makes the process go a lot smoother. So I think that 3 to 5 year time frame is a great time to start thinking about that, evaluating it, talking to some people about where do we stand right now and what do we need to do to get this to where it needs to be. Does that help answer? Yeah, that's a great point, Braxton. I think there's a lot of stuff you can get for free as a new organization. There's a lot of people who are more than happy to help you. Most people are genuinely, they genuinely care about your business and they want to help your business succeed. They recognize that will, as they establish a partnership with you, that will help them down the road. But I think there's lots of people and companies that are willing to invest in your company up front, and like Braxton says, give you some free advice, have some conversations on the phone, have some meetings, talk through some things without actually sending you a bill. Yeah, I think this is, again, for new organizations, you may not know kind of what our exit looks like, but keeping in mind that there are a lot of different alternatives. There's lots of different strategies that can come into play. There's the full sale of the business all the way down to selling a portion of the business, and there's lots of different types of organizations you can sell to. You can sell to, like Braxton said, to management or employees. You can sell to private equity. You can sell to strategic buyers. There's lots of different alternatives out there, and just kind of keeping that in mind. Grow your business. And market conditions can impact all of these groups. You know, I was talking to some friends back here a minute ago. Right now, for projects that we're doing on the buy side, we have, I think, 4 going on right now, and 3 of the 4 are with strategic buyers, and 1 is with a private equity buyer. So, which is a little bit unusual. Normally, I'd say it would be almost all private equity, at least the last couple of years. Almost all of our buy-side deals have been with private equity firms. But I think right now, because of market conditions, a lot of times the PE firms that are buying, they bring in debt to be part of that transaction often. With interest rates being high, the private equity market has definitely slowed. And so we're starting to see, I think, some of these strategic buyers that perhaps have debt facilities in place with fixed interest rates, so they're not necessarily, you know, they still have a good rate on their debt instruments. They're looking for opportunities where they can step in and buy some organizations. So it's interesting right now we've seen a little bit of a shift there, at least recently, with strategic buyers. And market conditions impact this as well. We saw the market was a little bit frothy, especially during 2021. There was so much M&A activity that those valuations started creeping up. The multiples on transactions started creeping up and got fairly high. I think most predictions are this year the expectations are that those valuations will come down a little bit, and probably won't be as high as what we've seen in the last, certainly in 2021, and I think things started to cool a little bit in 2022 as well. But market conditions can definitely impact those multiples as well. So timing has something to play in this. You know, I know as people are looking at transactions and evaluating when is the right time, part of it is your business. And I always tell people, focus on what you can control. You can't control what the market's doing necessarily. You can control what your business is doing. So if you focus on growing your business, your metrics, you're going to be poised in a good spot so that when that market timing is right, you can jump on it and make it happen when you feel like, hey, based on market conditions, based on where my company's at, I'm poised and ready to move. But timing, definitely market conditions can affect that timing as well. And I think this is a great slide because it kind of goes into your point earlier as a new business and a business owner. There's going to be all these things that are out there, and you're thinking, okay, how can I better structure my business? How can I grow my business? How can I poise my business for a potential transaction? And you've got to kind of, as a business owner, hone in on, okay, which of these is going to have the biggest impact right now, and where can I really invest some time and effort and money that's going to really result in something measurable for my company. And so, you know, it may be Salesforce that you think, hey, we've got our product, it's developed, we think we've got it, it's ready to hit the market. We need to build out our sales team. That is top priority right now. We're going to invest money in growing a sales team and really getting it out to the market. That may be what's right for your business right now. It may be the research and development to actually test and build and grow a product that's ready to hit the market. So it just depends on you as a business owner and where you strategically feel like it's going to be most advantageous to invest. We are still seeing some healthy multiples, though. It's not like they've crashed, you know, and they're kind of at that 2 to 3 range. We are still definitely seeing some good, strong multiples and good, strong purchase prices. So there's still, at least right now, we're still seeing what I believe are some pretty good transactions. It is interesting. I mean, certain industries really thrive at certain times. Like you can see their SaaS, really some great multiples there. But right now, it's really hard to get a SaaS deal done. I think you would say the same, right? Yeah, the SaaS market definitely has cooled significantly, whereas healthcare seems to be pretty solid, and a lot of healthcare stuff going on right now. So industries can really thrive. SaaS was so hot for a long time. I mean, it was really going strong, and it's cooled right now. I suspect it'll come back, but right now it's definitely in a slowdown spot as far as deals and deals getting done. Yeah, there was a flurry of activity because of the threat of capital gains rates going up significantly. That was it was announced. Everybody, was fearful it was going to happen, and so there was a flurry of activity. Companies trying to get deals done before the end of that year, before those tax rates went into effect. As it turns out, they didn't change. So I think there was a big rush that kind of turned out to be for nothing, I guess, sort of. And I think the change in interest rates perhaps has been a little more than what was anticipated. And so there has been a greater increase than perhaps a lot of people expected earlier last year. I don't know if you would have surveyed people at the first of last year if they would have predicted that there would have been the interest rate hikes that we saw during the year. So it's definitely been more, I think, than what they expected. But it'd be interesting to see this updated, to see if that has a bigger impact now. But at least based on the that type of raise, most people said no, we don't see that impacting the multiples. The other thing about that, I think one of the reasons why sell side due diligence has become so common is it gives the seller the opportunity to identify any red flags, skeletons in the closet, whatever you want to call them, and get those resolved before the buyer comes in. And that is so key, because if the buyer comes in and they see something that's wrong or it's a red flag, their antenna goes up and they start digging a little deeper, and then they find something else and their antenna goes up a little further and they start digging deeper. And it slows that process down. They get a lot more cautious. They start digging because their risk, in their mind, their risk is going up. So we try to, when we go in on a sell side, we work really hard to identify any of those issues and either resolve them completely, or if it's going to take a long time to resolve, at least kind of build some fences around it, if you will, to say, hey, we've identified the issue, we've identified the potential financial impact of that issue, and here's what it is. So when the buyer comes in, they already know about it, we've identified it, it's here, and here's the financial impact of that. You can kind of set that aside. We try and get all of those things identified so that the buyer process is really smooth. Yeah. Yeah. Yeah, great question. I think so. I'm going to divide that up just a little bit. I think first and foremost, your general day-to-day business, your day-to-day accounting, your processes. I think that is where you can incorporate systems that will work on an ongoing basis. Okay, that require fairly minimal adjustment and up. Okay, once you get that system in place. And we try to help automate as much of that as we possibly can for the clients that we work with. Once that system's in place, it's kind of clockwork. You know what happens. You know what happens every month. The transactions get posted. They get posted right. Everything's done. So that piece of it, generally, most companies can get that in a spot where it doesn't require a ton of, the big, massive house cleaning and painting everything and all that, new carpet, whatever. You just get those systems in place and it'll work for you. The actual due diligence or the actual quality of earnings report, that's different, because you don't want to be in a situation where you do it, and then you have to update it every quarter for years going forward. And so generally, we only do that when like it's go time. You've engaged with an investment banker. You're ready to go. They have given you a plan of, hey, this is what we need to get our information together to take you to market. We're ready to go, and we have a plan in place. At that point, we would come in and do that quality of earnings report. Now, we may still have to update that for a quarter or two. That happens. The deal isn't closed, and financial information may be a little stale. They want it updated. So we go in and update it for another month, for another quarter, or whatever. That happens. But usually it's only maybe a quarter or two at the most.